Everyone blames inflation, but inflation isn't the real problem, it's the symptom. If it feels harder to get ahead financially lately, you're not imagining it. You can do everything right: work, budget, avoid mistakes, and still feel like you're falling behind. For a lot of people, it feels like walking up a down escalator. You're moving forward, but the system keeps pushing back. Most explanations stop at inflation. Others say the system is broken. But neither explains why financial pressure keeps building across the economy even when growth, jobs, and markets look fine. That pressure doesn't come from one bad decision or one broken policy. It comes from how the US government finances itself, and how rising debt quietly changes how money flows through the system over time. Inflation isn't the cause, it's the mechanism. So to understand why this financial pressure keeps building and why ordinary people feel it more every year, we first need to understand how US government debt actually works. Because the structure of that debt doesn't behave the way most people think. Why US debt doesn't work like you think. Right now, the US government doesn't owe one giant bill waiting to be paid. It owes money in thousands of separate pieces called IOUs. Those IOUs are called bonds, loans investors give the government in exchange for interest. And the lenders aren't shadowy figures in a back room. They're retirement funds, banks, the American Central Bank, and foreign governments. Together, they make up the bond market. Here's the part most people miss. All that debt doesn't come due at once. Some bonds expire in months. Other bonds stretch out for decades. So when one bond comes due, the government doesn't sit down and pay it off. It swaps it. New bond issued. Old bond disappears. This process is called rolling the debt over. And here's the analogy that matters. It's like running a household where the mortgage, car loan, and credit cards all reset their interest rates at different times, forever. As long as interest rates stay low, the payments feel manageable. But the moment interest rates rise, the cost jumps immediately, not years later, not gradually, but right as the bills reset. That's how US debt works. The system keeps moving as long as borrowing stays cheap, and investors keep lending. This structure isn't dangerous on its own. The danger begins when it stops being a tool for managing debt and becomes the thing holding the system together. Why this system becomes a problem? The problem starts when borrowing is no longer optional. Tax revenue can't cover what the government is already committed to spending on schools, healthcare, roads, and defense. So borrowing fills the gap. And this isn't temporary. The US has run budget deficits for more than 20 years, meaning it spends more than it collects in taxes, not just during crises like the 2008 financial crash or COVID, but even during strong economic periods. Debt was supposed to rise in emergencies and fall during recoveries. Instead, it rises in both. That's why interest costs keep climbing even when the economy looks fine on the surface. That's why US credit ratings have been downgraded. Not because default is coming, but because higher debt leaves less cushioning when recessions, crises, or policy mistakes arrive. At this point, the system starts to feel familiar. It's like using a new credit card to pay off the old one. Bills still get paid. Nothing breaks right away. But the balance never shrinks. And more income disappears into interest. The system keeps running, but progress slows. That's what rising debt does to a country. It doesn't collapse overnight. It creates a slow squeeze, quietly diverting money from tomorrow to pay for yesterday. And when debt limits what a country can do economically, it eventually limits what it can do strategically. That's when debt stops being just a finance problem and starts becoming a power problem. Subscribe for everyday money clarity that actually helps so you can make better financial decisions. Why rising debt becomes a national security problem. High debt isn't just an economic issue. It's a constraint on national power. A country's strength depends on flexibility, the ability to respond quickly to wars, crises, and shocks. Debt quietly eats away at that flexibility. Every year, the US government spends more than it collects in taxes. That adds new debt. At the same time, interest builds on existing debt and is often paid by borrowing more, compounding the effect. And the real vulnerability is timing. There's no pause, no safe window. When interest rates rise, costs jump immediately because even old debt gets pulled forward and refinanced at higher interest rates. With national debt around $38 trillion, even small changes in interest rates matter. Interest alone now consumes hundreds of billions of dollars every year, money that can't be used for defense, readiness, or deterrence. As interest costs rise, governments lose room to maneuver. More money goes to servicing yesterday's promises, and less goes to dealing with tomorrow's threats. Over time, financial pressure turns into strategic pressure. That's how debt weakens power, not through collapse, but through slow erosion. And when options start disappearing, governments reach for the least visible escape. Why governments choose inflation? When debt becomes uncomfortable, governments look for a way out that doesn't trigger an obvious crisis. They almost never default. Instead, they inflate, meaning inflation. Inflation is when everyday prices rise, groceries, rent, clothes, so each dollar buys a little less than before. Here's what that looks like in practice, and the same logic applies to governments. Imagine taking out a 30-year mortgage for $300,000 with a $1,500 monthly payment. 10 years later, inflation has pushed prices and wages higher. That same $1,500 payment feels smaller compared to your income. On paper, nothing changed. In reality, the debt became easier to carry. That's exactly how inflation works on government debt. The government repays the same number of dollars, just worth less than before. No missed payments. No official default. No immediate crisis. The system keeps moving. But that quiet solution has a cost. Inflation acts like a hidden tax, reducing purchasing power without changing anything on paper. And over time, that cost gets pushed forward. It becomes a generational tax. And inflation looks like an escape valve for the government, until investors question whether they'll be repaid with money that holds its value. Bond markets, the real judge. This is the part most people overlook. Central banks set short-term interest, bond markets long-term. In the bond market, buying a government bond is how investors lend money to the government. When investors' confidence is high, interest rates stay low. When their confidence fades, interest rates rise. Those interest rates don't stay in Washington. They become the baseline for the entire economy. When government borrowing gets more expensive, so do mortgages, business loans, and student debt. Bond market investors ultimately care about repayment, protection from inflation, and whether public debt grows faster than the economy. When those risks feel contained, investors accept lower returns. When they don't, they demand higher returns, and the effects ripple outward through budgets, households, and businesses. That's why bond markets are the real judge. They don't vote. They price risk. And when borrowing costs rise for governments, households feel it directly. What this means for ordinary Americans. So, what does this mean in everyday life? When U.S. government debt grows large, the government has to pay higher interest rates to attract investors willing to lend. Those rates set the baseline cost of borrowing across the economy. As interest rates rise, mortgages, car loans, credit cards, student loans, and small business loans all become more expensive. Because households can't control national debt or interest rates, the practical question becomes how to protect yourself when borrowing gets more expensive. For most people, the answer starts with interest. When interest rates are high, interest compounds against you more quickly. The biggest financial mistake isn't missing an opportunity. It's carrying high-interest, variable-rate debt while interest rates remain elevated. The first priority is reducing exposure to high interest. High interest rates make it more important to pay down variable-rate debt because it may cost more in the future. Shuffling balances from one account to another doesn't fix the problem. Eliminating the debt does. Governments can roll debt far longer than households ever can. That's why keeping debt low, simple, and fixed whenever possible is so important. Fixed-rate debt is predictable. Lower overall debt means fewer dollars lost to interest and more flexibility if income changes or emergencies arise. Income stability matters too. A steady job is important, but extra income from freelancing, weekend work, or a small side job becomes especially valuable when borrowing is expensive. Extra income creates options. It allows faster debt payoff, higher savings, and less reliance on borrowing during tough periods. Over time, it also matters where compounding is working. Debt compounds automatically against you. Long-term investing compounds in your favor. That's why consistently investing in broad index funds like the S&P 500 over long periods has historically helped build wealth, while high-interest debt steadily erodes it. A dollar paid in 20% credit card interest is gone forever. A dollar invested for the long term has time to grow. Cash plays a role as well. Cash doesn't beat inflation, but it buys time and flexibility. It allows families to handle emergencies without being forced into high-interest borrowing when rates are already elevated. The key part is debt itself isn't evil. It helped fight recessions. It helped survive pandemics. The danger is never stopping debt. Debt that keeps growing turns future choices into obligations. Every dollar borrowed today limits options tomorrow. So the real question isn't whether the US can keep borrowing. It's what kind of country remains when borrowing replaces choice. Thank you for watching and subscribe for more videos like this.